Hi, everyone. Thanks for attending this event. I'd like to first give a shout out to TalkMarkets for publicizing this event and to Shindig for hosting it, particularly Mike. TalkMarkets, for those who are not aware of it, is a financial website much like Seeking Alpha, where people post articles um, about stocks, and it's a little broader than Seeking Alpha in the sense there are a lot of general financial articles as well. So if you haven't checked it out, please do so. It's a very informative site, and I'm sure you'll find something of interest. So in today's discussion, I'm going to give you my perspective on the US equity markets, particularly with what's happened in the elections and what's happened in the markets of late. And also at the end of it, I'd be open to any questions or comments, and we can just have a general discussion. With that, I'd like to um, uh, okay, and I've been told by Mike that the link to my page on TalkMarkets is on the upper right corner of your screen. So with that, I'd like to move to the presentation. So the disclaimers, this is just my personal opinion. So, take it with a grain of salt, and make sure you do your own research before actually investing based on any recommendations I might make or the discussion we have. This is just the table of contents. Okay, this is just a macro view. For those of you who attended my last presentation, it's pretty much a similar slide. I've updated it a little bit. Basically, the markets are at pretty much an all-time high. P's look a little stretched, but interest rates are very low as well. And the Fed will almost definitely be raising short-term rates, though it's not a given that the long-term rates will move up. So you have, even with short-term rates, even if they go up to 1%, you still have the 10-year rate about 2%, and if that spread might actually even compress. In my opinion, the major contributor to lower rates is the large deficit that the government is running. And since the Trump administration has no plans really to decrease the deficit, with the large deficit, the rates are likely to remain low. With oil prices, again, I think they're going to probably remain range bound in the current $40 to $60 range, because the producers keep pumping out oil. And if the Trump administration loosens regulations and encourages domestic production, that's only going to increase the available supply. On the bright side for prices, a lot of the companies have cut down their capex in the last year. So there isn't going to be a huge increase in production that's going to come about unless there's a big increase in prices that makes these producers recommit again to a big increase in capex. The main shocks to the market, I feel, are just external shocks. People getting worried about China, a big terrorist event, some kind of blow-ups on hedge funds or the quantitative funds. And finally, the big one is if the US government next year gets into a trade war with companies, with other countries, slaps tariffs, and then there are retaliatory tariffs on US products, etc. That can be a situation that can spiral out of control. Next slide, please. Here I have a slide again that I've used before where I talk about why interest rates are unlikely to rise meaningfully. And that is because higher government spending usually leads to lower rates. And it's a little counterintuitive, and usually when the government plans to spend more, people panic and they come out thinking that it's going to lead to really high inflation, really high rates, which is what people were saying at the beginning of the Obama administration, and just the opposite has happened. And if you look at the example of Japan, which has the highest debt to GDP ratios, constant infrastructure stimulus, they have the lowest interest rates, and they've always had the lowest interest rates, at least in the last few decades. And another way to think about it is, the government's never going to default on their debt because they can always print the money, and therefore the only way they can sustain higher amounts of debt is with lower interest rates. So it kind of normalizes that way. And the higher demand credit from the government crowds out private investment. Because of the lower private demand for credit, that again dampens interest rates. And as I said, with the new administration committed to fiscal expansion, both on the infrastructure and defense sides, and with really no plans to decrease spending on any other areas that I've heard of, the low interest rates will probably remain for the next 4 years at least. The only caveat here is if the lower taxes that the government plans on the corporate and the individual side rev up the economy and increase GDP growth about 3% or so, and the government spending decreases less than that, which might cause the deficit to GDP ratio to decline, then effectively you would have higher interest rates. So it all depends on where spending goes in relation to how the economy performs. But I think on a base case, you could assume that it's the economy might increase at a 2 to 3% rate, and probably spending at a similar amount. So we've had a big pullback in the debt markets across the board, from government bonds to investment grade corporate bonds to junk bonds. And my sense is that this may have been a little oversold, and debt might actually offer good value even at the low current interest rates. And I would recommend high yield corporate, because you get higher interest rates and the default rates are likely to remain pretty low. Next slide, please. On the corporate side, coming out of earnings season, I'd say that profit performance has been pretty disappointing. Almost for the market as a whole, profits actually are down year over year on a GAAP basis. And there's no real sign of a turnaround. So on the industrial side, because of the stronger dollar, US companies are finding it hard to compete globally, and profits are down there. On the commodity side, particularly oil and gas, again, profits are down. And finally, retail, I wouldn't say finally, but retail as well. There's a shift towards lower margin online shopping. And mall-based retailers continue to show declining revenue, declining margins, and declining profits. The stocks have had a good run of late because of the hope that tax cuts are going to spur consumption. I think this optimism is misplaced because people will probably continue to move their dollars online. And so, you have a stock like Macy's that's up about 20% even after missing their earnings this quarter. The stocks at maybe 15 times earnings that are continuing to decline. And analysts always assume that the decline will stop and profits will pick up the next year, and there's no sign of this. So I don't think Macy's profits are going to increase or stay stable next year. They'll probably continue to decline at a 10 to 20% rate. And so you have a big risk of multiple compression there, where the multiple can come down from 15 times to 12 or even 10 in a stress scenario. So there's a probably substantial downside in some of the retail stocks. There are a few pockets of strength like home improvement, so something like Home Depot, and the beauty category like Ulta. On the pharma side, we've had years of companies overpaying for acquisitions, pro formaing out the intangible amortization, and then pro formaing out stock comp, and a lot of R&D licensing charges, etc. You had a lot of hedge funds who got excited about the space and went in and pushed up valuations. And in a way, the company started believing their own story. So they'd make an acquisition, they'd announce an acquisition, and their stocks would go up because people would be excited about synergies. So soon they reached the point where they overloaded themselves with debt, and now the earnings aren't growing anymore. There aren't any other good acquisition opportunities either. And anytime you have a small whiff of bad news, the stocks drop, the order of 20%. And unfortunately, they're still not cheap. And in a lot of these companies, there may be very little equity value because of the debt they piled on. So examples of this are Valiant, Allergan, Mylan, and I feel that there are also people on the short side who've been like Jim Chanos, who are trying to expose what they've done, or at least talked about the fact that they really don't have much GAAP profits, and their the non-GAAP profits they put out are really meaningless. So I don't think there is much value in some of these companies. If you look at ones that do have strong GAAP earnings like Amgen, I think there is value. But not in some of the other ones where you have to be careful about looking at their GAAP earnings versus their self-proclaimed non-GAAP figures. Finally, another area of strength has been kind of advertising-related firms with political spending and the shift towards online. So companies like Google and Facebook have been taking increasing amount of dollars, and they have high valuations, but they're growing into them. And I'd say a lot of marketing dollars aren't spent very wisely. Someone is in charge of marketing and they're given a budget, and basically what they do is they put the money in the places they know. It's like in the old days, you couldn't be fired for buying IBM. In the new days, a marketer would now be fired for, buying ads on Google or Facebook. So, that's where most of the money is going. Even if, the payback may be there, may not be there, but effectively, it's the biggest player gets most of the dollars in this space. Okay, next slide, please. Here I've laid out, the major points of the Trump administration's economic agenda, and what the impact may be on the markets. So on the lower personal income tax rate, that's definitely good for the economy, because on the margin it incentivizes people to work more. On the lowering the corporate tax rate, I think that's a really big thing, because it provides an incentive for companies to recognize their profits in the US, not move abroad, and in fact, you might even have some kind of reverse inversions where companies would choose to domicile themselves in the US rather than abroad. And I don't even think it's going to lead to any loss in corporate tax revenue. I mean, even the lower because companies will recognize more revenue here, a lower rate might actually lead to a stable or even increasing amount of revenue. Then we have the repatriation of foreign profits at a lower rate. They're talking of a 10% rate or so. There's a huge amount of capital that's stuck abroad where the technology and pharma industrial companies have. If they bring it back, that's available to be spent on capex, dividends, buybacks, and that's going to flow through into the US economy. Then we come to a controversial one where, everyone's a little excited about the potential for infrastructure spending, and I don't actually think that this is a positive. If anything, it's neutral, maybe a little more, maybe even negative. And the point is, the money has to come from somewhere. If the government's spending more on infrastructure, they have to issue more bonds. If those bonds are bought by entities abroad, that's going to serve to strengthen the dollar. That's bad for on the margin, bad for U.S. industry. All infrastructure tends to be local. I can't think of a single infrastructure project which I think the federal government should be funding. So it should, they should be undertaken by state governments or local governments. Or, a lot of the problem is, if you look at something like LaGuardia Airport, the problem is it's owned by a state entity that then underinvests. And so the solution to increase investment there is probably to privatize it, and then the private entity then has an incentive to make productive investments. But now, when the benefits are going to be local, but the spending comes from the federal government, then you're going to have even uneconomic or very low return projects being funded. So, a local government is going to put their hands up and ask for federal money to build infrastructure for which they might contribute 10 or 20% of the funds. So it's almost like, free money coming in, and I don't think it's really a positive at all. Finally, what I talked about, tariffs and trade wars, this can be, negative to extremely negative. I think Trump is getting a free pass on this from the markets right now, because everyone's looking at the positives, but not this huge negative. And everyone talks of him being flexible. I'm not that positive on it, and the reason is because he surrounded himself with a group of economic advisors, and half of them, like Wilbur Ross, Peter Navarro, and Dan DeMico, the CEO of Nuco, they are ardent protectionists who've made their careers on protectionism. So Wilbur Ross buying industries, getting tariffs put on them, and he's become a billionaire in the process. Dan DeMico, again, he kept pushing for tariffs on steel products, and the Bush administration even listened to them and put tariffs on certain steel products, which helped the steel industry, the domestic steel industry. And then you have Peter Navarro, whose only distinguishing factor in his mediocrity is his constant China bashing and claims that the U.S. government should be imposing tariffs on all foreign products. You do have some moderating influences like Steve Moore, David Malpass. The problem is those people are concentrating more on the tax side. They're almost kind of picking their battles, and they're focusing on trying to get tax rates down and getting that through Congress. And so the protectionist people on the economic team almost might have a field day and might get some of these things their way. So all in all, I think the overall impact is positive, but it's not as great as a reduction in government spending might have been. So someone like, if you just had someone, a Paul Ryan plan, for instance, where They focus on getting entitlement spending in check, decreasing decreasing some domestic spending by converting things like Medicaid into block grants for states, not having all the infrastructure stimulus spending. That would have a much bigger impact on the economy and the markets than the kind of mixed economic proposals that we currently have. Okay, now I'd like to move on to some recommendations. The last time I talked, I did recommend the media space and the airlines because I just felt that both those sectors were undervalued, and almost every stock there was undervalued. So, but since then, those sectors have done pretty well. The airlines are up probably 30-40%, and media is probably up 15-20% since then. So now I think it's hard to find undervalued sectors as such. Technology had gone down last week, but at the beginning of last week, but then subsequently it's recovered. So I don't think it's great value. But on individual names, I think something like Disney, there's not too much downside there. It's a premium name. It's at 15 times earnings, and it's a company that's going to be around for the next 30-40 years at least, and they have a diverse business stream, although ESPN is a big part of their business, and that's what people are concerned about. Amgen stock, it was $170 stock, and now it's 140 and change. It's had a big decline because of pricing fears. They're not going to increase the prices on their drugs next year on some of their big drugs. On the other hand, it's not like they're going to decrease their prices either. And so, the stocks at only 12 times earnings, they are going to face some biosimilar competition, but they are going to produce their own biosimilars for drugs that other companies have too. So, I think that on the pharma space, I think that's the most attractive thing. You have hospital stocks that got clobbered down 20% or so after the election on fears that Obamacare will be repealed. Trump has already walked that back a little bit. He said he'd like to keep the good portions of it. I think it's highly unlikely that people who currently have coverage are going to lose it in any meaningful way. And so, HCA is the premier name of the space. It's the only name I'd recommend. It's at just 11 times earnings. The company continues to buy back stock. And so I think it has a decent amount of upside. I have a chemical company called LyondellBasell. It's cheap. It's at 9 times earnings. The stock's done nothing over the past year. They take all their free cash flow, dividend it out, and buy back stock. The only negative here is it's in a commodity industry, and if they're dependent on oil prices in kind of a circuitous way. Some of the prices of the end products depend on oil prices, and they're an American company, so. They're American. A lot of their operations are in the U.S. So a strong dollar negatively affects them as well. But at 9 times earnings, I think you're paid for the risk. There's a small home builder called LGI Homes that I think is pretty attractive because they make starter homes. So even if interest rates go up and the housing industry suffers a bit of a downturn, I think the starter home market should still continue to do well. It's at, again, 9 times earnings. It's growing at about 15-20% a year. One thing I should say about the earnings of a lot of home builders is that they tend to be a bit lower quality, because what happens is when the market's good, they invest a lot in land and building more houses, so they don't tend to generate any cash. And they also capitalize their interest, which is completely legal. I think it's just a flaw in gap where capitalization of interest is allowed, and so that inflates the earnings a little bit. Finally, airlines, as I talked about, I don't. I think when they were trading at 7-8 times earnings that they were 2 months ago, they really did offer good value, and now most of them are about 12 times earnings, and I don't really think they're very attractive, given that most estimates are for earnings to actually decline next year. And what we've seen is that every time there's been some kind of contract renegotiation, the employees have got huge raises, and most of the benefit from lower fuel costs has gone to the employees. As a result of which, the earnings next year for most airlines are going to be no higher than they were 2 years ago when oil was at $80 a barrel. Finally, on a fundamental basis, what matters are cash flow, earnings, companies productively deploying the cash they generate to buying back stock, dividending it out, making investments in their business, and finally, sensible acquisitions. Although that might be a bit of an oxymoron because you hardly see any of those. Because if you're going to pay a 30 or 40% premium to buy someone, it's hard to make those numbers work. You can in the early part of a cycle, so companies that made horizontal acquisitions of competitors in 2010, 2011, 2009, those were good deals. But if you're going out and making an acquisition now, you're most, in all likelihood, going to overpay. Finally, just from a technical aspect, I'm not a technical analyst, I'm just a fundamental analyst. So, but it's good to be cognizant of fundamental factors that might cause markets or stocks to decline. And I feel that it's highly likely that we might have a decline in the market early next year. You've had stocks, particularly financials, industrials, airlines going up, 15, 20, 30% in just 2 weeks. And not just you had the Russell 2000 small cap index that's up 15%. That's an index of 2,000 stocks. You've had a large stock like Goldman Sachs that's gone from 180 to 210. So $30 or 180 base. So it's a huge move in a short period of time. And the thinking is that lower regulation is going to be good for the financial companies, and I think it's good for sentiment. It's I don't see it affecting profits a big deal, because I don't think the companies are going to get rid of their compliance departments right now. And if anything, the lower regulations are going to decrease the barriers to entry, and you might have new competitors spring up and more price competition. Because right now these companies have had a huge moat around their businesses because of all the regulations. So most of the increase, in my opinion, is just a re-rating of the stocks and an increase in PEs. So you have a lot of inflows into ETFs, which are price insensitive. So you have money going into the financial sector ETF, and that ETF then goes out the next day and just buys stocks irrespective of the price, and that can cause a rapid move up in stock prices. A lot of investors and insiders don't want to sell their stock right now because they're almost convinced that tax rates are going to be lower next year. So you have a lower long-term capital gains tax rate, and then if individual income tax rates go down, that effectively decreases the short-term capital gains tax rate as well. So the thinking is that why sell now? Why we might as well wait a few months, and then even if you sell it at 5 or 10% less, you probably save that much or more on the taxes. And I think it's the similar thinking that went on before the elections when stocks were going down for the 2 weeks prior because people said, why take a risk on the election? Why we might as well just wait for the elections to get over and then buy stocks after that. And then, as you can see, things move up pretty rapidly when people stay on the sidelines and come back in, or they're in the market and they're all rushing for the exits. And these price moves can be, much bigger than the fundamentals might suggest. As I should also say that January has been a seasonally weak period the last few years. You had almost a 15% pullback in Jan-Feb this year. And last year you had a decline as well. And I think the last year we probably didn't have a pullback in January. It's probably 2012, I'm guessing, or maybe even 2013 as well. And then I just went and tried to look back to the last time tax rates were scheduled to decrease in a similar manner when a new presidential administration came in, and this was, I guess, 16 years ago when George Bush got elected, and he came in with a promise to decrease tax rates, and the market actually declined about 15% in January and February of 2001, and of course, it's hard to ascribe any causality to the move. It could also be that stocks were valued, internet bubble, and things like that. But I did notice that stocks did go up towards the end of the year, and then they subsequently declined in the first 2 months. So it's possible that the same thing could happen. And so if you're positive on any given stocks right now, I would recommend selling puts about maybe 10 to 15% below the current stock price, or just keep a note, physical or mental note of the stock, and if you have a pullback in Jan Feb, you can buy the stocks. And I think a 10% market decline would present good opportunities because you would have some stocks declining 15 to 20% in that scenario. And that's pretty much all I have. If you have any other questions, comments, you'd like to get in touch, that's my email. I also post articles on Seeking Alpha, where once in a while I post stock ideas. I also have a weekly paid service where I put out stock market tips based on stocks that have moved in the last week, particularly around earnings. And then, as I said, there's TalkMarkets as well. That's a good resource for stock-related info. Now, I'd welcome questions, and I have the first one, and I have the top 2 sectors for 2017. So this is a tough one to answer because things have already moved so much, and I would almost say that the hospital sector, I think, I would be contrarian and say that's a good sector to own because it's been beaten down. The only thing there is some of the stocks like Tenet and Community Health, they went out and made acquisitions and they got a lot of debt. So I wouldn't buy the sector as a whole. HCA is the best and biggest player in the sector, so I would buy that sector. And then in terms of the second sector, I would say some of the big biotechs I'm positive on, and I think some of them have come in as well. So Amgen, Biogen, Gilead, these companies although they're not going to raise prices, as I said, they're going to decrease prices either. And they also have a huge amount of cash offshore. And so if they, brought it back, in a repatriation holiday, that's cash that they could use as well. So I'd say, big cap biotech is another sector that I think is attractive. Okay, I have a question from Christopher. The last question was from Mike, by the way. He says, have you found that estimating a Trump effect on markets to be tougher than had Clinton won, given he is, sorry, can you just put that back? Given he is more of an unknown. I, I, I'd say that is definitely true, and it's not just me. I'd say it's the overall market. No one really had a if Trump wins playbook because frankly no one was expecting him to win. So earlier, before the elections, every time his poll numbers went up, the overall market went down. You didn't have this any kind of divergence that you've had after he's won. So you didn't have people buying financials because of loosening regulations. You didn't have people selling tech because um, of whatever he wasn't very friendly Silicon Valley, and you didn't have people buying infrastructure stocks because he would come up with an infrastructure plan. So it was almost like, after he won, people at quant funds stayed up all night, decided, what's going to be the impact, and then put this stuff into their computers. Their computers went out and bought stuff. Things moved. Then the momentum, people noticed something was moving, and they started buying it. And then you had some people, fundamental people, trying to rationalize those moves and then saying, that's true, and why don't we pile in as well? So as I said, it's tough because a lot of things are unknown. We know what the positives are, and he is justly getting credit for them. It's lower taxes, lower regulation. Um, uh, we know there's a possibility of huge negatives, and he's getting a free pass on those. And so it's we have to wait and see which part of it wins. There's something I mentioned last time when I had a Trump question, is that unlike Hillary, where I think you knew what to expect, and you knew that there wouldn't be any kind of course correction if things didn't work out. With Trump, I feel that if the economy were to do badly, you'd see that in lower real estate prices. And particularly with someone like Trump, who has a leveraged real estate empire, when he sees his equity going down, he's going to have a huge incentive to take corrective action. And so, that's the only positive, or kind of, the dampening effect on some of the negatives. If he went out with an all-out trade war, and the economy started to suffer, he might start listening to alternate voices who would tell him that it's because of those certain policies. While on the Democratic side, I don't think that would happen. I mean, every time something wouldn't work, they would claim that's because they're not doing enough of it. So, in that sense, I think it's more of an unknown, but also um, I think there's more hope of corrective action being taken as well.
Okay, I think that if anyone else has any last minute questions before we sign off here, for those who might have come in a little late, you can click your ask button or raise your hand. But I don't see any others coming in, but obviously you can contact Ranjit if you have any sort of offline questions. I'm sure he'll reach out to those of you also just to touch base. Um, So yeah, I don't see any more Ranjit, so I think you're off for the evening. I think. Thank you very much for presenting.
Yeah. Okay, great. Thanks a lot, Mike, for arranging this, and thank you all for attending. And if the interest continues, I'd love to do something like this every 2 to 3 months. Just catch up on what's happening in the markets, what to expect in earnings, and if we do this in January, maybe we'd be having a market pullback, and we can talk about some good stocks to buy at that time.
Okay, great. Thank you very much. Have a great night, everybody.
Okay. Thanks, Mike.